UK bakery GREGGS has had a rough 12 months with shares falling 24%. However, look under the hood and the business is doing just fine. At the latest price, GREGGS has a total market value of £2.1 billion. Account for cash and debt, and the enterprise value is just under 2 billion, although the company does have 300 million of leases. We don't yet have up-to-date financials for GREGGS, but we know that trailing 12-month revenue was a record at over 2 billion pounds. Net income as of July 2024 was 137 million, with 259 million of EBITDA and 159 million of free cash flow. So GREGGS stock is trading at around 1 times sales, 15 times earnings and 13 times free cash flow. That's a low valuation for GREGGS and suggests the stock may be near an entry point. GREGGS specialises in baked goods like sausage rolls, sandwiches and pies, and its brand is near an all-time high. The company has over 2,600 stores, which can be found on high streets, in supermarkets, petrol stations and retail centres. Looking at the financials paints a positive picture for GREGGS. Revenues have grown consistently over the last 10 years at an average rate of 10.6%, while free cash flow margins have gradually improved from 4.5% 10 years ago to 8.2% over the past 12 months. Despite this resilience, GREGGS stock has fallen after a slowdown in same-store sales, which were up only 2.5% in the latest trading update. Meanwhile, Deutsche Bank said that higher national insurance contributions could hurt the company by almost £100 million over the next 2 years. So investors in GREGGS face a number of questions. Can the company continue to grow given changing consumer preferences and the UK's weak economic outlook? Can margins be maintained in the face of increased wage costs? And how much growth is left for the business in the UK? After all, with 2,618 stores, there are almost twice as many GREGGS in the UK as there are McDonald's. To be fair, management is confident in its ability to grow sales and maintain its position. 2 years ago, they laid out a plan to double sales by 2026. Capital expenditures have also been increased for supply chain and logistics improvements. The completion of those investments sometime in 2026-2027 should partly offset the increases in wage costs. To value GREGGS, I assume the company grows revenue at an average rate of 6% a year over the next 10 years, with free cash flow margins of 8%. That's lower than 2022 but higher than the pre-pandemic average. In that scenario, GREGGS would generate £2.3 billion of cash flow over 10 years. A simple discounted cash flow model using a 10% discount rate and 2.5% terminal rate then puts the fair value at £26 a share. And I think that's conservative